chance. No. Spread it wide, keep the cost down low. Sit real still and let it grow. Making money makes sense. Up. Making money makes sense. Up. Talking real money. Mambo.
The Talking Real Money Mambo on Talking Real Money. It's the song of the day. Hey. You know, music is an important part of our lives, I think. It's right up there. It's one of the ways I kind of relax and center myself. Music. It's great. And we're serenading you with music. As a matter of fact, you want to stay tuned after the episode for a little surprise. Just stay tuned after.
A little surprise? I think it's a lot of surprise, actually. So
it's a little surprise.
Welcome
to Talking Real Money, the podcast. I'm Don. That's Tom. We've been talking real money for a very, 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 very long time because we're old codgers. And today we're going to talk about something that 40 years ago was highly controversial and now is accepted fact. It's accepted. And yet the industry refuses to, give up. And that is the smart money, the smart minds on Wall Street continually fail to beat the dumb money or the disciplined money or the academically oriented money. Once again, the numbers are in, Tom, and they say...
Before they get to the numbers, let me even show you how smart these people really are. This is somebody at Capital Group, which I think runs American Funds, right?
Yeah.
This is why. This is why they've done so well. Listen to the quote. It's really important to recognize that if you get the direction of travel on that travel theme wrong, the risk is outsized.
What does that mean?
I have no idea.
If you get the what? Give me that again.
The train's leaving the station without you or something. You really want me to read it again? No, you really don't.
I didn't get it, so I really wanted.
It's really important to recognize that if you get the direction of travel on that theme wrong, the risk is outsized.
So if you make a mistake picking stocks, you lose money. Okay, got it. Yes. Okay.
Which apparently he's giving a lot of advice to the people picking the stocks. Because the numbers are in Morningstar just out. Mm-hmm. As of the end of June.
This is active versus passive.
Correct. Traditional active. 27% of traditionally active U.S. large cap equity funds beat their benchmark, the passive fund alternatives, in the 12 months ending June 30th. Okay,
Wait.
1 out of 4.
If 27 beat, didn't 72 lose?
I think it's 73, but we're not
73,
counting.
Yeah, sorry.
Here's the more important
I'm rounding.
Number. In the decade through June, I think that's 10 years, 13% of traditionally active large cap funds beat their benchmarks. So 1 out of 10. Mm-hmm. Remember, you had to pick those in advance.
Right.
And you had to hold on to them for those 10 years to make sure it worked.
And over 20 years, it's even worse than that, according to SPIVA.
This is Morningstar's data that just came out, hot, literally off the press. And here's the part that's going to matter to them. While those funds, we just mentioned American funds, which is the largest traditionally active managed.
Yeah, it's absolutely the largest traditionally active.
They're big. It makes them a lot of money. I mean, if you run the number, if they have all those billions of dollars and they're charging 80 basis points, 0.80, it's a lot of money. But someone at State Street pointed this out. If you look at active equity mutual funds, they've had outflows every year consistently since 2015. That's a losing trend. I didn't read this beforehand. That's a losing trend only compared to the New York Jets. I could insert my football team there too.
Las Vegas Raiders.
LA,
I don't know.
Whatever.
I don't know where they're from.
Exactly. Doesn't really matter because they're not going anywhere anyway.
Soon they'll be the Oklahoma City Raiders or something.
I mean, the fascinating thing is if you ask these people today, why should they be enthusiastic about, active management? Oh, because it's different now. Because AI disruption has created a stock picker's market. Just how to pick them. That's why you can't pick the right ones. That's all.
But wait, shouldn't AI be able to beat the active managers because it's smarter? I don't know.
No, they're talking about AI disruption in the fact that you can pick the best stocks out of over other
only
stocks.
until they are not. And here's the other thing that I love to add into all of this argument. So SPIVA says now that 79% of active U.S. stock funds, traditionally active, outperformed over 20 years. So, 2 out of 10, and all of these basically do outperform.
So wait, to say that again, 2 out of 10.
2 out of 10.
Okay, which is higher than this number because this is 1 out of 10.
Wait, no.
Yeah.
You said it was 27%.
Well, I'm saying over 10 years. 13% in 10 years. So
okay.
Very small number.
Very small number. So let's use that. Let's say you got the 10% that outperform.
Yep.
How many of those outperform not because they're skilled or smart, but because they just happen to pick the right stock at the right time? How many of you, honestly, when you're truly honest with yourself, bought a stock at one point in your life that did either really well or really badly, and you know for a fact that neither one of those outcomes was because of your skill set, that you weren't lacking or having any kind of skill? It was just luck one way or the other, right? I mean, that's what it usually is.
Put your hands up.
Luck.
Look at all those hands. There are a lot of people that
it's
agree
luck.
with you there. But here's the thing. T. Rowe Price just announced, quote, conditions have shifted to favor active investing. AI means active stock selection will become increasingly important. According to Janice Henderson, finally, active managers can participate and join the passive money makers, according to Jeffries. So all of these companies are telling you, okay, it might have been tough the last decade, it might have been tough the last 2 decades, might have been tough the last 100 years, but this is now truly an active fund pickers, stock pickers market. Do you know why, by the way, Don? It's in the article. It points out very clearly why. Because stock market dispersion, that's the divergence between performance in individual stocks, has soared to the highest level in decades. That means you should be able to pick the winners and not own the losers, right? Well, it just hasn't happened that way. That's all.
I seem to remember, and I could be wrong, but I think I have good perspective because I have been doing an investing show of some kind for 38 years.
Yeah.
38.
Really? You counted that up? That's scary.
Yeah. So I just did a little checking to make sure my memory was right. But I looked back and I found that in 1998, Forbes called that the year of the stock picker.
No, always is, right?
I found an article where they claimed that 2010 was the year of the stock picker. 2012 was the year of the stock picker. 2013 was the year of the stock picker. 2014, 2017, 2019, 2020, 2022, 2023, 2024, and 2026 have all been the years of the stock picker. And add to that now 2027. It's going to be the year of the stock picker, I bet.
And this is also the year of the GOAT. I don't know how appropriate that is for the year of the stock picker, but throw that in there when you're thinking about it. All right, so what does all this mean? Well, I tell you what it means to the industry is more money is now in passive instruments than in the traditionally active. Flows into low-cost passive exchange-traded funds are going to hit $1 trillion in net inflows for the first time this year, showing how dominant they've all been. And I love to look at the reasons why. Why can't you pick stocks? Well, you have to be able to see the future, right? Or you have to know something.
You have to know something.
The bigger part, if you step back and look at it, and most of the academics will agree, is cost. The fact that you're paying, what did I just say? I mean, American Fund's average equity charge now is 75 basis point, 0.75, 0.8.
I'd have to look it up.
It's not cheap. I mean, we just looked at it. Didn't we look at it, American Fund's? No, I guess that was a Fidelity actively managed target date fund that charges 0.83. I mean, so that's an uphill climb because if you're only paying 0.15 or less, I mean, you can own total market for less than 10 basis points. The starting point is so much further ahead for the people running the passive or index style than it is the active that right out of the gate, you have a huge advantage. That's one. Number two, again, I think overlooked, not considered. There's a cost when you buy and sell stocks. Now, American Funds probably does that pretty inexpensively and much more frictionless than I would. But they're still paying something, and there's a cost of taxation, right? All those things, all those factors that go into increasing the cost of operating the fund. So there's not just the fee they're charging, there's the internal operating expense there. And here's the other one, Don, that I think gets overlooked. The short-term nature of active funds. I think you had a jingle once, there's a jingle somewhere, talking about quarters. The fact that if you're running a fund, every quarter you need to look good because that's just the nature of the business. As opposed to you and I, we don't have to look good every quarter. Well, we look good all the time, but our portfolio.
Well, we always look good on the radio or on a podcast.
Exactly.
We look so good in audio.
Because we still have that picture from 1998. So the thing is, though.
No, that picture was taken during the last retire meet.
Okay, I feel better. But the short-term nature of this business, and especially active fund management, ensures that things have to be done quickly. You don't have to do that when you're managing your own portfolio. It's a huge advantage. Because remember, they got to, what's the word they use, clean up their portfolio at the end of the quarter, window dressing, whatever it is.
Window dressing,
to make it look good. Oh, I had a great quarter. Those are important facts. But then the other one, and I think Dimensional Funds talked about this recently, there's more competition than ever in active management. There's hedge funds, there's private management, there's all the funds, et cetera. There's never been more smart people working on picking the right stocks, timing markets, being in the right sectors than ever before, and they're not doing it.
Do you know why they do it? Why don't they give up after years and years, literally decades of being killed by passive or academically based active funds? Why don't they just throw in the towel? What would be the logical answer for that?
It has something to do with it green, and you can snap it if you have it on your hands.
The average additional fees generated by active managers run in the United States run somewhere around $100 billion a year.
That's crazy.
We're talking real money there.
Yeah.
Real money. And by the way, I looked up the average annual American funds
how much?
fee. It's kind of hard to determine because C shares can skew it high.
Good point. Yeah.
But if you look at just their A shares, it's going to be about 60 basis points.
Okay.
About
So that
6
was a little high. But still, when you compare that to owning the total market at Vanguard for, is it 6 or 7? I mean, it's
nothing.
a tenth of the cost. So that adds up. And it makes it a steep hill to climb.
Yeah, really steep hill to climb. So what you want to do is stop trying to beat the market. You
Accept
can't.
it.
If they can't be smarter than the market, and they're not, then how do you think you're going to be smarter than the market, really? And if you have questions about your market intelligence, well, go to talkingrealmoney.com and speak them in with the microphone thing, and they'll be on Friday, or type them in, and then Tom gets them. And some of those, he actually called.
Sometimes he reads a mambo. Sometimes he calls a bang. Sometimes he reads, sometimes he does. Well, now here is call.
Let's go to Westlake, Ohio, and Greg is the seventh caller. No, you're not seventh caller. I'm kidding. You're the first caller today. How's it going?
Okay, very good.
Good to hear from you. My pleasure. Absolutely. How can we help
Thanks for
you?
taking the question.
You betcha.
The question is about the best place for assets in my portfolio. I had my portfolio was set up a few years ago through Vanguard's personal advisor service when I retired. And the advisor put me into VTI, VXUS, BND, and BNDX between my taxable account, rollover IRA, and a Roth IRA. Now, my Roth IRA said the VXUS, the International Equity. That's the loan thing that's in there. So now I'm self-managing now, and I plan to start doing Roth conversions this year. Would it be best to keep the Roth just VXUS ETF, or should I diversify with some VTI or possibly add some VVR?
Yeah, that's a really great question. I mean, here's, in a general sense, and I'm sure you know this, but asset location is very important. And in the Roth, it would be best to have the riskiest assets. You mentioned VBR, for example. I'd prefer to see an AVUV because it has a greater tilt to small and to value than VBR. But those are the kind of things, yes, you would want in your Roth because it should grow the fastest then. It's going to have the most variability, volatility, but the upside should be greater. So as much of that as you can pack into that Roth, yes. So if I was making conversions, then yeah, I'd be moving money from my IRA to my Roth and buying more of those things. But overall, and I'm sure you know this too, you want to make sure that you have the stock to bond ratio that will achieve your, return to what you're trying to make within your risk tolerance. So you don't want to change that just based on having more stuff in your Roth that's risky, right? You want to, if you're 60-40, you want to remain a 60-40, right? That makes sense. So yeah, and that would be the first thing I'd figure out. I'd say I have, whatever number of dollars, I want to be 60-40. So therefore, 40% of the money needs to be in bonds. The best place for the bonds, as you I'm sure are also aware, would be the IRA, because the interest they pay is not going to be taxable. It's simply going to, stay there in the IRA. And then when you take the money out eventually or convert it, you pay tax on that. So that's the best place to have the, sort of interest-bearing stuff like bonds. Taxable should be more in stocks, and Roth certainly should be the riskier stocks. You mentioned, as I said, VBR, something like that. But that's how I would play it. First, decide on the overall asset allocation, and then the location would be secondary. But your thinking is correct there, yes.
Okay. Yeah, I've been, pretty much keeping it the same as, what the fella with Vanguard put me in. Now, as far as like the small cap value, about what percentage of the equity would you put in there? Because right now I've got my equity is 60, again, U.S. 60, international 40.
Yeah, I mean, if I was going to just make it simple, then I would take the 60 divided in half, basically. And I'd probably, or maybe 2/3 of it is in the U.S. and 1/3 is international, if you really want to make it simple. But then I would divide it. This is where it gets a little trickier. I would probably, if I was doing this on my own, divide that money between bigger stocks like the S&P 500 and international large cap, and smaller stocks like the aforementioned VBR and an international small cap value fund, so that you have a balance between big and small, value and growth. You want to have all those things in there. So it would get to be a little harder. And you have some exposure. The problem you face a bit is when you're using a VT or VTI, you have some exposure to that small in value, just not as much as we'd like you to have. So maybe instead of going full tilt, dividing that in half, maybe you just take a quarter of the money and put that in one of those small cap value funds, AVUV, VBR, something like that, still leaving 3/4 in the total market, because you don't want to get too far out of you don't want to have too much in the small cap value, because there's times when that goes out of favor too. You just want to have a balance of those things. So maybe the right thing here, to keep it simple, would be 2/3 in the U.S., 1/3 international, and then out of that stock part have a 3/4 in the larger, and then, in the total market, and 1/4 in the small cap value, both U.S. and internationally.
Okay.
Does that make sense?
Yeah. With the Roth, you basically kind of want that to be kind of more risky, because it's going to be the last thing you're going to need.
Last thing, but also tax-free growth. That's the other thing people overlook. It's like, well, that's going to grow. I don't plan on ever spending my Roth. Hope to leave it to my kids. And you hope that grows a ton. You sound like a similar type of person to me. So, that grows and grows and grows tax-free, and then you hand it to somebody else, or you spend it at the end of your life. So that really, for me, that makes total sense to have the riskier assets in that location.
Would you leave any of it to any of your listeners?
You got a specific bank account I can just send that over to, Greg? Is that easy for you?
Goodness, man. All right. Yeah. The only thing, you talk about taxes, I'm looking at, for next year, like I say, it's the first time I'm doing the conversion.
Yeah.
So, I should be in safe harbor, because my tax was pretty low last year.
Yep.
And this year I started my pension.
Yep.
And so they've been taken out of the pension. As long as they're withholding more out of the the pension than I paid last year, for taxable, I should be okay.
You don't want to
About that.
Yeah, you don't want to bust the bracket, and you don't want to get IRMAA involved in your situation here either. Both of those.
Yeah,
Pay attention to both of those.
I think I'm pretty far from IRMAA, but
Good. Yep.
uh,
So you're in a great place. Yeah, I mean, then I would just sort of slowly move that, that IRA over to the Roth every year, make the conversions, and then look at your tax years as they come along and say, I've got this much space to do more. I'm going to do move a little more money over. But it sounds like you're making a lot of good decisions to me.
I haven't heard that in a long time.
Oh, well, then let me be the first to congratulate you on that. So
All right.
listen, thanks for listening. Thanks for reaching out to us. And it's great to have you on the program.
Yeah, thanks for all you and Don do.
Appreciate it, Greg. Take care.
All right. Be well.
Bye-bye.
He's got 'em on paper.
On paper, he's got 'em in hand, in hand.
He printed 'em out like folks used to do and reads 'em out loud just for you.
Yep. He does do the written ones too. Yeah. He mambos his way into the written questions.
The idea of me doing do not even want to think about
Yeah,
that.
I certainly don't want to see it. I
just
know
saying
I
that.
don't want to see it.
I just saw this movie the other night, Normal, Illinois, but I think it was Normal, Minnesota, wasn't it?
It was Normal, Minnesota,
Yeah, Normal, Minnesota, kind of
with Bob Odenkirk, whose
kind of a strange tale.
his new genre is lots of blood and gore.
Yeah, and they do it so
And it
much
was
that it doesn't even-
gratuitous.
Yeah, it's not. It doesn't even bother you at the end. Like another guy's head got blown off. Yeah, okay, whatever.
Yeah.
The character's not very sympathetic. So
It was enjoyable. There was a lot. I'm glad I didn't watch it with Debbie. She would have walked out. But apparently he really needs Vince Gilligan again.
yeah, well, don't we all?
Yeah,
If I had a
yeah, Vince
TV show, I'd be
Gilligan.
calling Vince. Anyway, this comes from Normal, Illinois. Matt writes, thoughts on an all-domestic portfolio for retirement for a 20-year-old? Because that's like a 40-year portfolio. Here's the suggestion: 75% VTI and 25% AVU fee. Money is in a Roth
AVU fee.
IRA. AVUV. Don't watch out for those AVUV rays because they can really get you. No, I don't like this. Why?
No, why? See, it's the home field bias. It's just, well, it's America. You should just invest in America.
Well,
Well, I'm telling you, we have we've been having, and I'm not making this a comparison for you to predict the future, but we're going through a similar period to that we went through in the late 90s when the stock market was just hot year after year. The domestic market was hot year after year after year, and people poured money into technology stocks, kind of like they're doing now.
yeah.
And the next decade, and I'm not saying this is going to be the case for the next decade, but the next decade was bad.
But remember, the last year you made more by being exposed to international than the U.S.
Right. And that's the
A
thing.
lot more.
Yeah. From 2000 to 2010, if you didn't have international in your portfolio, you lost money
Yeah.
in the S&P 500 for a solid decade. A solid decade of losses. Now, if that's not a case for having global investments, I don't know what is. That diversify.
Yeah, okay, but also in terms of having two funds in this portfolio for a 20-year-old,
AVGE.
yeah, you get the one fund. You don't need to buy two because you have to
GE.
rebalance it. Yeah, it's simple. Really is AVGE. Simple. Or DFAW.
DFAW.
Either way. Joe from Lansdale, Pennsylvania. Hello, gentlemen. My wife and I are both 55 and would like to retire in 4.5 years at age 60. Can you imagine retiring so young? Anyway, we have $3.1 million in retirement savings, invested 70% in stock ETFs, 30% in fixed income. Approximately 2/3 is traditional and 1/3 is in Roth. We contribute $70K per year to Roth investments. Good for you.
Yeah, that's great.
Our goal is to have $4 million at age 60. Sounds like you will. I mean, but so using the 4% rule, they can withdraw $160,000 per year to cover our expenses and cost of health insurance. By my calculations, we can reach that goal with an average annual return of 3.75% plus the annual investments to help mitigate. Here's the question.
Yeah.
To help mitigate the sequence of return risk in our early retirement years, what do you think about shifting to, say, 40% in stocks, 60% in fixed income. Remember, now they're in a 70-30
okay.
for the next 5 years, and then moving 3% annually back to stocks for the following 10 years. So
Sounds like a lot of work.
70-30 at age 70.
I have an idea. Why don't you just go to like 60-40 or 50-50?
I think you should today.
Yeah, just do that now. Just reduce the risk exposure. That reduces your risk in the early years. Have plenty of, by the way, of liquid money, so that if we have a short-term downturn in the market, you don't have to touch anything. You just touch your emergency money. But
plus the fact in that portfolio is going to be selling bonds and buying stocks. It may be a difficult time for stocks. I don't know. It could be an odd time to be doing that kind of thing, that rebalancing. I'd be worried.
Well, I would just not go to that much trouble. That just sounds like a lot of work.
Start with a 60-40
and
today.
There's really nothing that speaks to that strategy. There's no academic research that says this is going to be better. The best thing you can be is in the market to the extent you, one, can stand to be in it, and two, need to be in it. So you need to balance that need to be in it with your desire to be in it. You said you need a 3.75% return. Is that right?
Yeah.
You don't have to be aggressive. You could go 40-60 and just stay there.
And start with that and do that now. The
Just
best you can
stay
be
there.
is
But
be all that you can be.
I would work my way gradually toward it, because getting that rebalancing done could be
I
a
start
little...
with the 70-30 that he is now. Maybe go
go to
5% a year.
Yeah, just
Till
go a
you're back
little
to
a
the
year until you get down...
40-60 or 50-50.
When you get to the 40-60 by the time you're 60.
I really struggle with people that have more than half their money in bonds. It's fine if you think you've won the game and you don't want to reduce volatility.
But you see, that's what he basically said, that he won the game.
Yeah, okay.
All I need is 3.75.
Which is a very slight return.
And we talk about that a lot. Your risk profile is your risk tolerance and your risk need. Why take more risk than you need?
Put it all in 30-year Treasury bonds that are now paying 5.3%.
Well, the yield curve is no longer flat.
No, 5.3.
It's not inverted. It's normal. That's the way it used to be when long bonds paid more than short bonds. Remember those days?
By the way, I asked our crack portfolio staff today about why, because I know there's going to come up. Maybe I should ask you, because you're the answer man. Why the U.S. government is so headstrong on supporting the yen.
The importance of the Japanese economy in the Asian world order, because of China's great power, and we're supporting it to keep their economy afloat.
Okay, good answer. I don't know if that's the right answer. But
I think that's the right answer. It's got to be the right answer, because unless there's a fix-in and somebody's getting paid off.
Oh, not in today's world.
No, that never happens.
All right, Alexandria, Virginia. Got one more time for one more squeeze in here.
Yeah.
Okay. Matt.
It's a podcast. There's no clock.
Right. I could be here for days. Don't even think about it. Matt from Alexandria, Virginia. My mom has a Roth account with an advisor she set up 20 years ago and never touched. She hasn't received any services from that advisor in 10 plus years. Mm-hmm. After looking at the investments and seeing she's paying 0.83 for a target date fund, we want to move that.
Wait, say that number again. For a target date fund?
Which I think you could buy for 1/4 of that cost basically anywhere else. We want to move that to Vanguard, where she has other accounts. Okay, that's good thinking, Matt. My understanding is the investments would be transferred directly from Fidelity to Vanguard without being cashed first, but my question is how that works when they're being transferred from an institutional share class to a do-it-yourself individual account. There's no...
Doesn't matter.
That doesn't matter. She'll be contacting Vanguard to get the answer as well, but I thought I might be nice to her. By the way, Roth. So she could just sell it on the Roth and turn around and buy whatever she wanted at the other account. There's no reason to transfer it anyway. Why would you transfer it?
Yeah, you wouldn't need to.
No.
Vanguard,
but the fund? Can I give you the fund name?
Yeah, please, because you said it 0.83. Yeah, 0.83. Go ahead.
The fund name is the Fidelity Advisory Freedom 2025 Fund,
Advisory.
Class A shares. So that means you paid a commission too.
All right. So let's start with the very beginning of the note. It's not an advisor anymore. It's a salesperson. That's why you haven't heard from them, because they're not making another sale. They don't get paid to service. They get paid to sell. Yeah. They got 5.75% from her up front. That was it. They're done. They're not going to call again unless it's time to sell that and buy something else for another commission. So don't expect them to contact you. They're not a fee-only advisor. They're just not. This is one of the things I hate about Fidelity sometimes.
They're on both
They want to
sides
be
of the aisle.
all
Yep.
things to all people.
They do. Yep.
And I don't like that. Be one or be the other. At least T. Rowe Price and Janus and American Funds are honest that they're broker-sold products. And that 0.83, let's put that in perspective.
Yeah,
you
how
said
much?
you could get in for a lot less elsewhere.
I imagine
Well, let's take a look at a Vanguard Target Retirement Fund.
2025.
Okay.
Okay.
They're
'cause
pretty
that's
much
gonna
all the
be
same.
Probably a 60-40 or something in that area.
Yeah. And what would you guess the expense ratio
I was
might
trying
be?
to decide in the high teens, is it? I don't know.
No, it's actually 1/10 of the Fidelity. 8 basis points.
8 basis points. I mean,
8/100ths of 1%.
that's outrageous that you've been there for 20 years, but that's over and done. So here's what I would do, Matt. I would just simply sell the fund at Fidelity, move the money. There's no tax ramification to that. Move the money over to the new Roth setup at Vanguard. And if it has to be a target date fund, then buy the 2025 Vanguard target date fund for, Don just said, 8 versus
basis points and no load.
80.
And that's what this industry fascinates me. All of these people are kind of unnecessary anymore. You can buy this on your own. You don't need a salesperson selling it to you for 5 3/4%. You don't need an advisor. In most cases, if this is your whole portfolio, you don't need anybody advising you at this juncture in your life until your life gets more complicated. You can do this on the cheap, and you should. It's only smart. That's what the theme of today's show is, and that's what our little surprise that I created relates to coming up after the show ends. So you get all the money information, and then if you want to hang around for the bonus afterward. And by the way, many of these bonus things are available at talkingrealmoney.com. All right, it's a money music bonus. Okay.
Are you going to get nominated for one of those Music Choice Awards or something, or how's that going to work?
I doubt it. Not when you get helped by AI.
Can't wait.
I'm getting better at
wanna
writing the
thank
lyrics,
everybody.
though. I'm really getting better at writing lyrics.
Oh, the lyrics are outstanding.
This one I kind of like. Oh, and I'm working on one. You're going to love this one. My working title is, hold on, let me make sure That Steak's Not Free.
Sakes. Love it.
I'm having fun.
I think it's great. And the comments
having
so
fun.
far. By the way, I have not gone to our online reviews. I got to look at that.
Well, I just got a note from a woman today. She said, I love the music because it gives me another reason to listen every day.
Okay. But I want to go online and see if anybody said, "What's with this music stuff?"
No,
Give me a
actually,
break.
no one has.
Okay. So
No
please
one
don't
has.
go write that just because
I go into the reviews.
I
every
don't look very
couple of
often. But I was on
weeks.
vacation, as you know, so I was looking at them when I was there.
You were looking at them. Let's see. We I'm just going to go to the reviews and see.
Tell Don, quit
6
writing
days
those
ago.
stupid songs all the time. Huh?
I love this one. This is from someone who speaks Spanish. Me encanta el programa.
Oh, thank you. That's very kind.
Saludos desde. Great podcast. I've been hearing since the pandemic. Learned a lot. So.
Wow. Okay.
And then here's of course this is the same person who continues to write reviews. Same person. They don't like the fact that we don't like crypto. These guys continue to keep their heads in the sand and refuse to look at the world around them. Just a lazy, put together show. Avoid it.
Yeah, well, if it's going to be crypto or the sand, my head's going to go real deep. I can tell you that. But you keep burying me in it. So.
And then the rest are pretty good. And then here's one of the regular ones. These guys had a good run with the 60-40 portfolio, but
no more.
They're missing how the bond side hasn't been working.
I just looked, by the way, the last 3 years, an intermediate term bond strategy made, guess what? Total return, about 4% a year.
That's what it makes. That's what it's always made, and we've never claimed it was likely to do anything else.
Don, it should do better. And I just had this argument at the all-staff meeting today. We're not in a period of what you would have to say high inflation. Inflation averages going back to the 1930s about 3% a year. So to be in an inflation period of time when it's about 4 is not high inflation. Now, it's far higher than it was earlier this decade, sure. That was unusually low inflation. I have lived through high inflation. In the 70s.
Double-digit inflation.
Yeah, in the early 80s.
I
That's
had
high
a
inflation.
13% mortgage on a house.
My first mortgage, 13.5%. So when
Yeah.
people say, well, mortgage rates are really high. No, they're not at 6.5%. Now, they're higher certainly than they were at 0 or 2 or whatever.
Well, two. I looked it up.
But,
2 at like 2 3/8 was the low.
Okay, so they're higher than that, but they're not high. So, at any rate, we could argue semantics, I suppose. But
All right.
so fair enough.
Hey, you want
That's enough.
but if you'd like some free help, go to talkingrealmoney.com, click on Meet an Advisor. There will be no charge and no obligation, and truly no high pressure sales pitch. Although that's what the steak dinner people say too. We're just telling the truth. And if you want to ask us questions, click on the button that says Ask a Question, or click on the microphone for the Friday Q&A thing that I do. And remember, I'm Don. That's Tom, and we're
Talking real money.
Once every dollar had a genius attached to it. A name on the door, a corner office, a man who read the tape. He came down from the mountain with a list, and the list had 12 names on it.
We paid him, oh, we paid him gladly.
1%, 2%, whatever it took.
Because how could it be otherwise? How could smart not be dumb? How could try and not beat sitting still?
He was on the cover in a good suit. He had a nickname, he had a streak, he had a war story. And every quarter the letter came, explaining, always explaining
Why this year was the year that didn't count?
Then somebody actually looked, somebody sat down and added it up.
20 years of it, all of it, every fun.
Then the whole room went very quiet.
Nobody's wearing anything. Nobody ever was.
There are too many eyes on the same street to fool.
Too many minds on the very same page.
The one thing you can know for certain is the price. Fees matter more than brains. Fees matter more than brains. 10 years out, most of them lose. 20 years out, damn near all of them. And the handful still standing at the end look exactly like what luck looks like. Exactly like what luck looks like.
Put 10,000 people in a field. Tell them all to flip a coin. Send home everyone who flips tails. Then do it again
And again,
and again.
and again. Someone is still standing.
Someone is always still standing.
Give him a magazine cover.
Give him a fund.
Give him your money.
He's not a genius.
He's the last one
Holding a coin. Nobody's
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.